I think there's an assumption that the normal path of economic progress will be made, and that the cumulative and lagged effect will eventually come through, and we'll see that slowdown, but that it is still tracking within that soft landing kind of channel of data. So if we see that, you look at S&P earnings for 24, you're still projecting over 10% growth for 2024 earnings, which to me seems very optimistic if you're also trying to price in a fall in inflation and a moderation in growth. So I think that expectation of earnings next year is the real danger point on equities. But Q3 should be perfectly reasonable. If you've had a GDP print which will surprise around 4.5%-5%, something like that, then that's got to be fairly supportive for company earnings in the short term.
I don't think there's anything normalised about this. I mean, just look at one thing we've barely mentioned already on programming today on CNBC is the fact that the claims figure was at the lowest level since January. At the same time where we hit over 8% on the 30-year mortgage in the last 24 hours. I mean, just our viewers, just take a step back, everybody. Jobs figures are the best they've been this year on one measure. And at the same time, consumers are being squeezed with the highest financing on the most popular mortgage product that we've seen in at least one generation as well. Al, I don't think there's anything normal about this. And my worry is there is a veneer of control from the Federal Reserve, which the market is clinging onto. I'm not entirely sure they're in control of the narrative here.
Well, you can see from the pricing of inflation, so you look at your break-even or your five-year, it looks like the market is still giving the Fed a fairly high degree of credibility. So that stayed, break-even, five-year break-evens around 2.2, 2.3, bit of volatility, but it has stayed relatively calm. And what's happened is that your nominal rate has gone up. So the Fed has credibility that they will get to that 2% or low 2% area, but the market is accepting that it's going to take higher for longer, and that's why your nominal rate's gone up, and that's why your real rate's gone up. So I think, yes, the market is still assigning that credibility. It's when you see that those inflation expectations become unanchored, and suddenly you see 2.8, 3% expectations in the market, which would be more consistent with what we just saw on that the University of Michigan that came out on Friday, which ticked up a bit, that consumer expectations of inflation are quite high. But in terms of
yeah, sorry about that, Al. Just to perhaps get in there, Arabile here. Good morning to you. If I mean, it's not priced in at present, it seems, right? I mean, if you take a look at even the CME number, it just doesn't look like a hike is priced in at all this year. But if the Fed was to hike, because Jay Powell did say it's not yet restrictive at this level, if he was to hike, 25 basis points is surely not going to cut it. He's going to have to do a little bit more than that, considering how hot this economy is, right? I mean, he's wanting data to drop off quite considerably in order to get to a stable sort of economy. But we're not anywhere near that, are we?
Yeah, so I think what he said was policy is restrictive, but it's not too restrictive. So that's they think they can get away with it without getting too much damage to the economy. The Fed speakers have come out in the last 2 weeks and really talk down that November hike. But what's happened is it's just pushed it back. So now it's December or January rather than November or December. And the reason for that, and you mentioned financial conditions in the intro, with the move in the long-term rates, financial conditions now are as tight as they were 1 year ago. So we've had that big step up the end of September, start of October. And what we saw this time last year was that really affected the November inflation data. So that's why they're going to skip November, because you have to wait for that November data, which they'll get just before the December meeting. So if there's no slowing, if November inflation is still pretty solid, still around that 3%, 3.2, somewhere like that, then I think your chance of a December or January hike needs to be much higher. I would have put it at 50-50. I think the market's probably pricing a 40% chance of one more hike. But the market's completely ignoring the dot plot. And when you've only got 2 meetings left, and the majority of the FOMC think there's another hike coming, I think the market is, as you say, perhaps being a little bit complacent on one more hike.